So let's go over the market situation that I think we're currently in right now. We're approaching a resistance with the S&P 500 at around $4,200 on that index. There's still a lot of uncertainty. Global tensions are rising. It seems like China and others are trying to dethrone the US dollar. We have high probabilities of an upcoming recession. And all Fed members, or most of them at least, are saying that rates are going to be higher for longer. We are coming off a banking crisis with Silicon Valley Bank and others failing. Long story short, the uncertainty is high, and there's still a lot of risk out there in the market. And that's why many investors are sitting on cash. The purpose of this video is to go over what I believe is a good way to kind of park some cash so that you can wait for opportunities to present themselves. Whether that be in the equity market if we see a crash in the stock market, or it can be in real estate, residential, or potentially even commercial. It can be in whatever you think is going to fall, and then you can buy at cheap prices. So in the meantime, you're just trying to build up your reserves and park your cash somewhere that could potentially provide you some reward at very low risk, because the main purpose is for you to have capital to deploy when things start to fall down. So what we're going to be talking about on today's video is money market funds. Now, please do not confuse money market funds with money market accounts. Although they are similar in the yields, they are very different vehicles. We can talk about money market accounts in a separate video. These are essentially savings accounts that will be provided or can be provided by your financial institutions, by your banks. For instance, if you have an account, a savings account with Ally, you can also open up a money market account, and the yield or the interest rate on that account is going to be slightly higher than the interest rate on your savings account. And both accounts are going to be insured by the FDIC. Money market funds, however, are different. This is where you can park your money in a brokerage. So if you have money in, let's say, a Thinkorswim account, which is owned by TD Ameritrade, which is owned by Charles Schwab, you can put money into some of the Charles Schwab's money market funds. And there are many to go over, and we'll discuss the differences between basically the three main types of money market funds. And we'll go over some of the terminology when looking at these funds so that it makes sense to you. But most of them are going to be very similar. For instance, a fund at Charles Schwab is going to be very similar to a fund at Fidelity. The yield might be slightly different. The expense ratios might be slightly different. But we're really talking about very small differences. So what exactly is a money market fund? Well, it is a fund, a mutual fund that invests in very short-term, low-risk assets. The purpose or the intent of a money market fund is to provide the investor with a very highly liquid asset that provides very low risk and also returns some yield through interest rates. When you put your money in a money market fund, that fund will invest in some of the following assets. You have a banker's acceptance, which is also known as a BA, and this is essentially short-term debt guaranteed by a commercial bank. You have CDs. If you're watching this channel, you probably know what a CD is. You also have repurchase agreements, which is the repo market, where a bank will park cash at the Federal Reserve and the Federal Reserve will pay them some yield, some interest to park their cash there. That's called the overnight repo. And then you also have US Treasuries. Now, with a money market fund, they're going to be very short-term treasuries. And a treasury is US debt. Now, when you're looking through your brokerage or you're looking online at different money market funds, there are essentially three different types. Now, the one that's going to offer the highest yield is what is known as a prime money market fund. And what that does, it invests in floating rate debt and commercial paper of non-treasury assets like those issued by corporation, U.S. government agencies, and government-sponsored enterprises. Because some of what they buy is non-government issued debt, that means there's a little bit higher risk. But really, all money market funds are going to be low risk when compared to investing in the S&P 500. A government money market fund is going to offer a slightly lower yield than a prime money market fund, but it's also going to offer less risk because all of this is going to be government-backed debt. So a government money market fund invests at least 99.5% of its total assets in cash, government securities, and repurchase agreements that are fully collateralized by cash or government securities. So this is going to offer lower risk. And then the other money market fund that you're going to see is what's called tax exempt. And these are going to be municipal money market funds. They are going to invest in primarily municipal bonds. And the reason why it's called a tax exempt money market fund is because it's going to be exempt from federal income tax and potentially even state income tax as well. So what we're looking at right now are the money market funds that are provided by Charles Schwab. And this first category are your prime money funds. Now, there are going to be two different prime money funds here, and the difference between them is who's able to buy into these money market funds. The top one's going to be for people like you and I, retail investors. The minimal initial investment is at $0. The other one is going to be for institutional investors where you have to put at least $1 million in cash to get into the fund. The money fund that is available to retail investors has a 7-day yield of 4.68%, while the one for institutional investors has a 7-day yield at 4.83%. Slightly better, but not by much. Doesn't make a huge difference. Now, notice how it says 7-day yield with waivers. That means you're going to reinvest your money in the fund. And a 7-day yield is not the return you're going to get in 7 days. It's the annualized return if the interest rate was to stay the same for 52 weeks. 7 days is 1 week. There's 52 weeks in a year. Now, this will change throughout the time that you have money in a money market fund. So your annualized return is going to be slightly different than what's stated in the 7-day yield. But if rates stay pretty steady or if they increase, your yield's going to stay around the same or get better. If rates start to fall and come down, your 7-day yield is going to come down with it. Because with all of these funds, they are primarily driven by the interest rate on the federal funds rate and short-term treasuries. So what's happening in the bond market and what the Federal Reserve is doing will impact the rate you get on your money market fund. But that's why it's so intriguing and so interesting and so compelling to put money right now in the money market fund. Because you can essentially get 4.5% or better with very, very low risk. And that is compelling, especially when the market is extremely risky, in my personal opinion. So it's 4.68% for that prime money market fund, but the government and treasury money fund is 4.5%. Slightly lower yield, slightly lower risk. And then when we get into the tax exempt, the municipal money market funds, these are much lower in yield. They're at 2.15%, but they are tax exempt, which is going to increase your total yield. But you have to do some math to take that into consideration. A prime is fine. They're all fine. if you ask me. That's my personal opinion, at least. Now, if we dive further into that prime money market fund for retail investors offered by Charles Schwab, another thing to consider is the net expense ratio, because that is going to eat into your yield, which in this case for Charles Schwab is 0.34%. So it's not a huge fee, but it's something to consider when you're shopping around looking for money market funds. Now, based on an article from Forbes for April of 2023, these are the best money market funds that they had listed. They had Fidelity's Prime Money Market Fund, which has a minimum investment of $1, so it's available to retail investors, an expense ratio of 0.42%, and a 7-day yield of 4.55%. You also have Vanguard's, which has a $3,000 minimum investment criteria with an expense ratio that's very low at 0.11% and a 7-day yield which is quite high at 4.77%. Then you have some others that I'm not going to really mention, because I think the three big ones are that most traders will have options of buying into is Fidelity, Charles Schwab, and Vanguard. And when we look at these three, they're all good options, but Vanguard is the best when it comes to yield and expense ratio. Then when we compare Fidelity against Charles Schwab, they're very comparable. Fidelity, 0.42% expense ratio and a 7-day yield of 4.55. Charles Schwab has a lower expense ratio of 0.34% and a higher 7-day yield at 4.68%. So in my personal opinion, Vanguard is number one, but you can't just put $1 in, you got to put $3,000 minimum, then Charles Schwab, then Fidelity. But they're all fine. They all serve the same purpose. So if you're looking to park some cash, get some yield at very low risk, any of those money market funds will do that for you. Now, if you're interested in learning more about the stock market, trading the market, and investing in this market, then definitely consider hitting that subscribe button, ringing that bell, and smashing that like button. You can also join the Patreon, which is only $5 a month, and it gives you access to a private Discord server where I give live trade alerts. We go over market news. Other members are also shouting out the trades that they're getting into. We share articles. A link is provided down below. Outside of that, I thank you so much for your time. I'll see you on the next video. It's been real. It's been fun. It's been real fun. And this is We Are Investing. And I'm out. See ya.